Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Today, I have my co-host back. Eason is back from vacation. We're really looking forward to being able to answer your questions today. This is a show that is designed to try to help people get, more successful with their retirement. And so we answer questions that come up. You can still send your questions in now if you would like to our email address at asktom@talkmoneywithtom.com. And we'll be able to, answer those as they come in. You can go into the chat box and put your questions in there. Obviously, also send in the questions at any time during the week. Give us a little chance to get ready for them. That would be nice too. And then we, of course, one of the things we really enjoy is covering some of the things that come up in our strategy sessions with our clients. Kind of pass it along so everybody can get some knowledge out of this as far as that goes. So we are really dedicated to trying to help educate the public and our clients about retirement, about asset management, about tax planning, retirement planning, those types of things. And so we have created this channel, the Talk Money with Tom channel. We now have over 800 videos on this channel. So if you'd like to subscribe to the channel, you can hit the subscribe button. A little bell next to it will let you know, when we post something new. And this will help you, I think, continue to increase your knowledge base on retirement. Even if you're working with somebody like us, it's still better, I think, to have some exposure to all these areas. I think it helps tremendously as far as that goes. So obviously, we're also available for appointment. We have a book appointment button at the top of our website. Looks just like this. Website link is right here on the channel. You can go there too. Schedule a 30-minute video or phone call appointment with us if you'd like. And so this is a live show. Sometimes I think it's fun to just check in and see where we mess up. But we really enjoy this, and we hope that you enjoy it also. So we'll look forward to getting started today. I do always like to start off the week with a summary of what I've seen happen, to the stock market this week. And so right now as we speak here on Friday, the market's still open, but we were hitting low points for the year so far. Kind of broke through that 20% down barrier from the high point that happened back in January to the low point that is happening right now. And really what we're seeing altogether is that every time there's kind of a nice run upward, so Friday we had a great up day, Tuesday of this week we had a really good up day, and then Wednesday we had a big sell-off, right? So things just kind of really fell off, and the catalyst for Wednesday was very interesting. So Target, which is a really well-respected company that has been doing very well throughout the pandemic, reported their earnings, and they missed their earnings by quite a bit, and they talked about really the fact that they have two things happening. Number one is that the consumer was shifting from kind of the non-food type items to more money on basics. And so they have excess inventory in some of those other areas because Target sells all kinds of things besides just food. And then obviously the other thing that they talked about was the increased costs that were coming from transportation, specifically from gas price increases. So we're kind of seeing the effect here of what's going on from the Ukraine scenario where we saw oil prices come up and obviously gas. There's some delay and lag in there. But this was followed by Tuesday's report from Walmart, who basically said the same things. We're struggling with the same areas. And what happened was that these companies they're low-price companies in terms of their products, and so they don't really have the capability to increase their prices as easily, theoretically, as some of the other companies, because at the same time, Tuesday and Wednesday of this week, Home Depot and Lowe's both reported, and in both cases their earnings were okay. And Home Depot even talked about the ability to raise their overall price without having any real demand drop off. So they saw very strong demand. So it depends on which consumer you have as to how that's going to affect. But we saw the market come down pretty dramatically on Wednesday with that report from Target. And Target itself took a 25% hit, which is really incredible to me. And then it actually fell another 5% the next day. So a pretty big destruction of value in that company. I do think at some point in time, this is where the values are going to be. A company I really like Target altogether. I think that they're very well run. They're now selling at 13 times earnings. And one of the, I guess, the silver lining to what's happening here is that there's going to be some opportunities to pick up really high quality companies that are creating great earnings and at some decent low prices. So unfortunately, right now, the problem with these earning problems with Target and Walmart is sort of like the canary in the coal mine as far as the market was concerned. And so if Target and Walmart can't increase price to keep up with their increased costs, what happens when it's Apple or Microsoft or Nvidia or any of these other companies that are out there that can't do that? Then you're going to end up with lower profits than expected, because right now the expectation for profits is roughly 9-10% per quarter, and 9-10% for the whole year for 2023 on the analyst expectations, another 10% growth expectations on 2023. So the analysts are looking at this and still see earnings potential growth, a little slower than we've had as we've come out of this pandemic with all this money behind us, but nonetheless still expecting growth. Unfortunately, when you look back at big market downturns or recessionary time periods, what the analysts are looking at isn't a great predictor of what's going to be happening. Sometimes they get a little pessimistic, like they were during the pandemic, and maybe they're a little optimistic now, during this particular period of time. And so really what you want to be able to do now, all right, first of all, assuming you're still hanging in there, you've got your portfolio hopefully well allocated, you've got the right amount of bond versus stock so that, your downturn, the market's down 20%, maybe you're down 7 or 8, depending on your allocation to stock and bond, and is to kind of look at what's going to happen to the economy. The stock market is one of the predictors that we look at when we look at economic downturns. But there's a kind of a funny saying that the stock market has predicted 9 of the last 5 recessions. So it's not a perfect predictor of you're looking at for recessions. And really, recessions are the big issue right now. That's what we're looking at. Are we going to have one or not? The consensus seems to be we're going to have one, but that doesn't mean we will. Because the economy is very, very hot right now. The Federal Reserve has talked about being able to kind of push the brake pedal down, and the economy still has enough room to be able to slow down the economy, get inflation back in line without pushing the economy all the way into recession. A lot of people don't believe that, and that's why the market is kind of falling right here too. Having said that, what is a great predictor of a future recession? And because you kind of want to combine those together, in my opinion, right now. You want to look at what the market's doing. So it's telling us things are going to be bad here in the future for the economy, at least in its opinion, but it's not always right. And then you want to look at some predictors for what is going to be happening with the economy in terms of a recession. So I've done a lot of work on this. You look at Treasury yield spreads between the 2 and the 10-year. You look at all of these different areas. And the one predictor that I have found that seems to be the most accurate is the leading economic indicator, which I will put up here. And so this is put out by the Conference Board. It seems like a majority of the really good indicators that have been successful historically at predicting in advance a recession are baskets of indicators, not just one like the Treasury yield or what have you, but it's in this case 10 different indicators. And so this is going back to 1988. If you look closely here, you can see that we've peaked on the blue line, which is the indicator, average of 9 months in advance historically. But you can see here before the 90, it was 18 months. Before the 2000 recession, it was 11 months. Before the 2008, it was 21 months. It says 0 there before the 2020 because the 2020 wasn't an economic event until we closed everything down. So a little different. But nonetheless, if you look at it now, still going up. However, we did see the indicator go down in January, but it popped right back up and we hit an all-time high in March. Okay, then it came down in April. That was just announced yesterday. And so 1 month moves aren't enough. If you look closely at this line, you can see lots of little wiggles in there where the economy kept going, even though the indicator came down or flattened out a little bit. My research going back to 1960 is you need at least a 1% drop from the all-time high, which was established in March, before it is, I think, an accurate indicator that we're going to have recession. So we did drop 0.3% in April. So we got another 0.7% of drop to go before, in my opinion, this is signaling a fairly strong signal that we could have a recession. And that's when, in my research, you want to be looking at staying in the market as much as possible, only because things can turn around so quickly, and things can turn around very quick. And unfortunately, that creates a problem for getting back in. If you get out right now and things turn around, you could get back in at a higher point. And so you really want that bigger downturn that you're getting out of. And those generally are oriented around a recession happening as the stock market's falling, right? And so what we're looking at here is the leading indicators. They've flattened really for the year altogether. All that means is slower growth. So the conference board, which puts out this indicators, is now projecting 2.3% gross domestic product growth for the year. And just that's what they consider kind of a slow, normal, moderate growth. But we want to watch this on an ongoing basis and see what happens. And because that combination of the 200-day moving average coming down on the S&P 500 and at least a 1% fall off the high here on the leading economic indicators historically has been a point in time where you probably want to get defensive, or at least batten down the hatches and kind of deal with what's going to be coming our way as far as that goes. So that's what's happening right now. We're still trying to figure out where things are going to go in that regards. We're looking for what we call capitulation point, where if we are going to have a bottom, you generally have some kind of giving up. Where there's a big downturn, it pierces really low, you get that big stretch. The VIX, the fear index would be up really high. Those type of things. We are seeing a pretty good run up in the VIX today, but nothing substantial. It's just below 33 right now on that number. So anyway, those are the things that we're watching for right now, and that's what's going on as far as that goes. But hang in there. I do think there'll be some opportunities. If things get worse, I do think we should get defensive. But in the meantime, just keep focusing on kind of the positive sides, because we're hanging in there, because things could turn around. I mean, there are a lot of things that can happen on the negative that are kind of surprises. Target's earnings report on Wednesday was a negative surprise, and that's what caused the market to go down. But again, there are a lot of things that can happen on the positive side. One of the things I've been reading the most about is what's happening in China. And I think there's a potential there for them to surprise us, that even though they're doing these lockdowns, that they're still able to keep production up fairly adequately. We'll see how that plays out, but they could change their mind tomorrow and decide to do a different policy for how they're doing their lockdowns that might be more conducive. If that happened, the market would respond quite positively. So there are lots of different pieces out there where we could start to see some increases. However, I would be surprised to see the market just recover tomorrow. I think this kind of deterioration is kind of a psychological damage that happens to the market. That's going to take some time for it to come back around, and I'd sure like to see the Federal Reserve start to get more accommodative, at least with their comments. I don't really see that happening until September, personally, because they've got a June meeting, a July meeting. Maybe they start to soften their language just because the market is down. I think they're kind of happy to have the market down, because there's two things that drive consumer spending, the stock market going up and house prices going up. And we're seeing the stock market come down, and we've seen house prices are still holding up, but we're seeing some of the precursors for house prices possibly coming down. New home sales are down 3 months in a row. Applications for new home building are down. That's part of this leading economic index. As a matter of fact, that's one of the main drivers for why it came down in April. And so those things are things that the Federal Reserve is really, I think, probably looking for, because the consumer is continuing to spend, and that's driving inflation. So anyway, that's what I see happening now for this week. I look forward to talking to you again next week. Thank you. All right. Well, we've got questions. Hopefully, again, you can send in questions at any point in time if you'd like. But let's start off with some of the questions that we do have already.
So our first question is, I'm feeling a bit shaky with the market volatility and being in the stock market. What should I do?
Yeah, it's kind of really probably the highlight question right now is just really, what do I do, right? I mean, we all got really used to for a really long period of time, fantastic returns, and to have a drop. The pandemic was worse. I mean, it dropped 35%. We're down 20% here on the S&P. But the pandemic it was a different environment. It was very obvious why things were happening. They were closing things down. There was plenty of fear, certainly, because you had both financial and physical fear at the same time. And really, that's how this whole channel got launched, was right in the middle of that. The 22nd of March 2020 is when we did our first video on this channel, just to try to help people understand what was going on. Well, I think one of the things that I would recommend here in this particular environment, ignoring all the things that we might be able to do, getting defensive and what's happening to the economy and all those things, we're already down a certain amount. Everybody is down from some high point. But what does that really mean to you? It's like, okay, a lot of times we'll look at something and we'll say, I used to be here and now I'm here and I've lost X amount of dollars in that downturn. That's going to happen all the time when you're in the stock market. And I think it's really more of a situation of trying to at least make sure you're looking long term, right? And so long term's different for everybody, depending on your age and kind of your outlook and those types of things. But one of the things that we use that seems to help a lot is our retirement plan. And again, whether you're 20 or 40 or 70, right? The retirement plan still is super important, and it gives you this Monte Carlo simulation. So actually, let me give you an example of what that looks like. Again, most of you have seen this before, but when I'm doing the strategy sessions now with the clients, they're concerned about the valuation drop, right? And we go through that. We talk about what's happened, how the account's done versus the market, that aspect of it, what I see coming, right? And then we go to their retirement plan and we take a look at what that means to their future. And so when you run the Monte Carlo simulation like today, it is because our plans are live and all the accounts are linked in, the accounts are now worth less. What happened to the Monte Carlo simulation? Because that really shows you the rest of your life. You can tell, okay, hey, in November we were here and now we're here, right? Lower. But what's that mean for the rest of your life? And that's where Monte Carlo simulation comes in. So at this lower dollar amount, we run this Monte Carlo simulation with the same asset allocation. And what happens? And so, again, it depends. We've got scenario here. We push the button. Okay, they're still at 96%, right? So this is how I think you need to really look at the market. If you're back to 75% or something much lower than that, we probably need to start making some adjustments someplace, either adjustments to lifestyle, cutting back on what you're withdrawing from these accounts if you are doing that, saving more if you're in a pre-retirement situation where you can actually push more money into your accounts to kind of make up for some of the losses, or portfolio allocation changes to deal with that, right? I would use this long-term perspective of Monte Carlo simulation because this is the rest of my life. What's going to happen to the rest of my life? So far I'm down X amount and I have 96%, right? Okay, it's not really affecting the rest of my life looking at it from a Monte Carlo simulation standpoint versus, hey, I'm at 70%. Okay, I have to make some adjustments. And so to answer that question of, what do I do with this market volatility, take a look at how it's impacting the rest of your life and then see, what you need to do from there. And I think that's that'd be the gold standard, in my opinion, on how to make adjustments to your lifestyle, your savings rate, your spending rate, or your portfolio, right? I mean, those are the things, right?
And another way is you can kind of frame it as an idea. If you're still putting money into the market, this is a time that you could acquire stocks at a discount. Because when you think about it, one of the best periods in our history is when we come from that very initial bottom and when we come up. And so if you're just dollar costing into that amount, you're getting those gains over time.
Yeah, just before the show, we were talking about that exactly. Because both of us kind of like Target, for example, and is that an opportunity or what have you? And I remember in 2008, because it was a financial crisis, the banking system really took a hit, and Citibank was down. I think it was $1, but it might have been $5. But it was very, very low. We just looked it up. It's it's up $48, right? So somebody made a tremendous amount of money buying Citibank or Bank of America or any of these things, because they didn't go out of business. They may not still be the greatest institutions on earth. Obviously there's different opinions on that, but there's opportunity to kind of do well in this environment as far as that goes. It does depend on your age, your outlook, your risk tolerance, kind of where you're at as to what you should be doing. But that is one of the things that drives me personally in these downturns, is just looking for opportunity and trying to find that point where I want to try to take advantage of that. Again, with each client, that's different because they all have different outlooks. But it is one of the things that helps me mentally here, is that, hey, everything's now on sale. I like these companies, and now they're cheaper. Their price to earnings ratios are now much more in line with kind of long-term averages or something along those lines. Man, that might be a good time to buy these. So maybe we're not at the bottom yet.
Yeah.
That's hard to tell. That's one of the most difficult things to tell, I think, which is why it's so difficult to tell when to get back in. But I do think also that helps me tremendously is knowing, okay, I've suffered X amount of loss. I push that button on the Monte Carlo simulation. I'm still okay, or I'm not. Then I'm going to get concerned. But if I'm still okay, I'm okay. I'm all right. My strategies are still working. I've got enough money. My overall plan is okay, right? And so this is the answer. Not how much the market came down, how much more the market's going to come down, when it's going to recover, what the Federal Reserve's going to do. This is the answer.
Yep.
Monte Carlo simulation is the answer to that question. Figure out what it means to you for the rest of your life, and then make adjustments based on that, because that's the way to do it. So, good. Other questions?
So I'm nearing retirement. I recently heard about delayed retirement credits, and how do those work?
Delayed retirement credits is a fancy word for the fact that if you do not take your Social Security at your full retirement age, you will actually start getting paid, sort of a bonus in a way, I guess, more and more money on your Social Security. And so the more that you delay taking your Social Security, the more that you can receive at that point in time. And just to kind of capsulize that, it grows at 0.2% per month. So every single month that goes by past your full retirement age, you are going to get an increase on your Social Security benefit, guaranteed by the U.S. government. That comes out to 8% a year, right? Then when you look at the other part, which is kind of fascinating, even though you're not getting it, you still receive the cost of living increase. And so last year, or this year, for 2022, the cost of living increase was 5.9%. So you get that 8% plus that 5.9%. Your Social Security benefit just grew 13.9%, right, in 1 year, guaranteed by the U.S. government, because you didn't take it. Other advantages of not taking, you don't have to pay the taxes on it, because a lot of times it's taxable for people. It doesn't really have, and that guaranteed growth. The rumors around how much they're going to increase the cost of living increase for 2023 are pretty dramatic. So there might be a really, another add-on, even more than the 5.9%. We will find out in October when they announce that.
And it's powerful when you think about it. 8% guaranteed every year you can gain. If I had an investment that I can guarantee 8% every year, I would love that. Maybe I just 100% put all my investments into that.
Yeah, exactly. Looks really good today. Then we're at the S&P's down 20% essentially for the year. 8% growth is looking fantastic. And there's all kinds of advantages that fit into that. But one of the others is that because you don't take it and your Social Security is growing and growing and growing, when you do finally take it, future cost of living increases will be based on that bigger number. And so it adds up to more dollars. So the caveats, though, obviously if you're not taking it, you're not getting it, and you could have gotten it, and you could have saved it or invested it or done something, and how does that work? And so there are ways to take a look at that. There are calculators where we can put in, hey, let's say you save it and got a 6 or 8% rate of return. How does that compare? Let's say, if let's say you just start to spend it because you need it and don't want to spend these other assets. What's the break-even age if you do wait? We can figure that out. What assets would you withdraw from?
Mm-hmm.
Right? If you're not taking Social Security at full retirement age and you're delaying, you're living off of something. What is it? That's part of the retirement plan, and that's where we can kind of go in and do Social Security maximization inside of a retirement plan, because that allows us to be able to see where we're going to get that money from. How much tax are we, having to pay to get that money potentially, and then what are we losing in terms of rate of return by taking that money out versus, what we could get from Social Security. So it's delayed retirement credits are really important. I think they're super interesting to look at that dynamic. It's called Social Security maximization in my world, right? Where we're trying to maximize the possibility of income from Social Security based on expected life expectancy, where you're going to withdraw the money from, how much you're going to get from the government and growth, and all these pieces. It's actually fairly complex. And one of the problems that people have is there's nowhere to go to get the answers to this. The Social Security Department really isn't going to answer your questions. They shouldn't, honestly, because in order to answer your questions accurately, they need to know everything about you, which is what we end up having to do, right, before we give a recommendation. And they're not going to do that. They're not going to sit down there and whip out, the financial planning program or Social Security maximization, gather all of your information, all of your other income source. That's not going to happen. There's nowhere else to go to get this information. And I've run into a lot of people that try to do it themselves, and very few people get all of the pieces in there that need to be in there to really calculate it correctly. So this is one of the things that we help people with right here, is trying to figure out how to maximize Social Security. So anyway, it's a really fascinating area. I love the question.
So this is a question about someone that's kind of concerned about the market. I have a trip booked. My hotel and flight have already been paid for. I have the money budgeted for food and kind of all that entertainment expenses in my bank account. What are your thoughts about canceling this trip, because inflation's kind of spiraling right now?
Yeah, that's a good question, because travel's picking up now. I got a lot of clients that are, going out now, really since April, end of this year, all kinds of scheduled trips this summer, a lot of pent-up demand in the travel arena, just because of not being able to travel for quite a while. So, you've got this trip booked, right? You've already paid for a lot of the pieces. Probably, if you did it right, you could get most of those back if you had to, right? Especially in this world, I'd be a little careful of not having refundable tickets and what have you. But I guess I look at it like, well, you've already committed to this to the point where you've already scheduled it, you've saved the money, you've already booked the flight, the hotels, you've got all these pieces together. Life is kind of short too, so you don't know what's going to happen going forward. I think if you've got a window to be able to take a trip like that, you probably should take it. But inflation is a concern, right?
Yeah.
So, hey, I just spent this money, and inflation goes skyrocketing, and I'm going to look back and say, wow, I wish I still had that money to be able to afford the basic things that I have. So there are some situations depending on, your overall financial scenario, right? If you're really close to the edge financially, and you're pushing yourself even closer with this trip, and a lot of people do that, believe me. But that there may be some argument to kind of getting that money back. However, the problem I have is that we don't know what inflation's going to be. Everybody says it's going to continue to skyrocket. It's going to continue to go up, and it's totally out of control. Not everybody, but there's a lot of people out there that feel that way. And I think that you have to be really careful, because we don't know. I mean, that's something that's a bit unknowable as far as that goes. Inflation did peak so far in March. We've had 1 month down, which isn't enough to say we're going down, but it's a start. And so, what happens next month and the month after that? And I guess I would hate to give up a trip and find out that inflation turned out to not be such a big deal. And it did fall into that kind of 2 to 4% range in the next 6 to 12 months, which isn't great. But it's better than 7 to 8 that we've been in for a while here. So, personally, unless it was a really dire scenario where you probably shouldn't be taking the trip in the first place, if it's that dire,
Yeah.
then I'd probably take that trip. And one of the things that the question did mention was saving in other areas to kind of make up for it. I think that's a great idea,
Yeah.
right? And there are a lot of places that people can save.
Yeah, and especially if you're, it's also about living your life. If your mental health is suffering because you're still just working and grinding through, and not taking this trip is probably a little bit worse in the end. Because even though there's optimal financial decisions, we should also still be able to make these decisions within boundaries of keeping ourselves happy. Because we shouldn't be sacrificing everything to have that perfect financial outcome. We should be trying to live our lives while still trying to make good overall decisions.
Yeah, I agree. I mean, there's I have some wild stories from my years with clients, and I've met some really wealthy people who have become wealthy because they didn't do anything. I mean, even to the point where they have a car that's 20, 30 years old with 12,000 miles, didn't even drive, didn't travel. And their big goal in life was to accumulate money, and they bought stocks, and that was their thrill. Really, even I remember one scenario where it was just counting the dividends. That was the fun. Didn't need to travel because I could count the dividends. There's nothing wrong with that. There really isn't, because that's what lifestyle meant to that person. So it is different for everybody, but for most people, there's some kind of balance that people are trying to achieve. Because you can go the other way, right, where you're living for the day, spending every nickel that comes in all the time, never prepared for any emergency whatsoever, and thinking that life is just short and around the corner could be some disaster. So I'm doing what I can do now. Again, as long as you're willing to put up with the ramifications of that, that's okay too. But I do think you need to kind of identify where you're at on that spectrum, and be able to pick and choose. There isn't a perfect answer for everybody, but it is. I think probably a balance applies to more people.
Yeah.
All right. What else do we have?
So our next question is, am I required to take a required minimum distribution if I'm still working?
All right. So, up until I think it was 2017, the answer was definitively yes, no matter what. And so, back at that time, the minimum required distribution age was 70 and a half. And just to redefine this, just for you that forgot about what this is, if you have a retirement plan like a 401k or an IRA or a 403b, once you hit this age, it's now 72. You have to start taking money out of those accounts. There's a little formula that they use and say, here's how much you have to take out. If you don't, the penalty is 50% of what you should take out. So if you're supposed to take out 20 and you don't, the penalty is $10,000. So it's worth paying attention to make sure that that doesn't happen. But they did put one loophole in there now, that you do not have to take money out of your 401k if you're still working. And so now it's 72, yeah? And so if you are 72 and you're still working and you've got this 401k at that office, at that workplace, you don't have to take money out of it until you stop working. And I've only run into this a few times, actually. And this is literally out of thousands of situations where somebody is working past that age. It does happen, but not very common. So for the most part, it doesn't apply anyway. But you could make an argument, and this is what Issa and I were talking about earlier. You could keep, because you still have to withdraw from your other retirement plans.
Yep.
So let's say you had 4 different businesses that you worked at over your lifetime. You're in the 4th one, but you had these other 3 401ks at those other places. If they're still there, you still have to withdraw on those. If you roll those out into an IRA, you still have to withdraw on those. Now, the one that you have at your current employment, you can leave. So you could make an argument that you could roll all of your 401ks forward into your current employer, And if you're planning on working past age 72, you wouldn't have to take a required minimum distribution until a later point in time. There's some downfalls to that, but that's a strategy that's kind of interesting. I've never heard of anybody doing it, but it is a possibility as far as that goes. Now, the one other thing to keep in mind is that it looks like they're going to be moving the required minimum distribution age back. There was a bill that was in the House that passed 415 to 5, that's now in the Senate, that would move the required minimum distribution age back this year to 73, and then over a number of years all the way back to 75. So again, you're starting to stretch that back farther and farther. A lot less likely there's going to be people working past 75. It can happen, but anyway, that's a really fascinating aspect of it as far as that goes. So that the answer is yes, with that one exception for the 401k that is at your current employment as long as you're still employed there.
Yeah, and so if you have a SEP IRA and you're self-employed, you still have to take RMDs. So unfortunately, it's only when you're a company-sponsored plan.
Yeah.
And so that's one caveat to watch out for, because I know a lot of people tend to consult past their into their 70s in retirement, but if you're recontributing, you'd still have to take those RMDs.
That's right. It's only for the 401k for whatever reason. And sometimes sometimes you wonder about the logic of why not spread it to all the retirement plans? If you're still working, you're still employed. But one thing to keep in mind about all the time with retirement, with required minimum distributions, it is the government's desire to generate taxable income. They have allowed you up until that age to not pay income on that asset or that income, and now they want you to start withdrawing. That's what RMDs are about. It's a forced cash flow system into taxable income for the U.S. government. So that's probably why they only have the one loophole. Just because some negotiation broke down on getting the other ones included, and because it costs too much money for the government. So again, I don't think this is a huge issue, but it is kind of fascinating.
Yeah. So our next question kind of relates to our very first question is, what is time horizon and how does it change my outlook?
What is time horizon and how does it change? Okay, so I'm assuming that means with investing, right? So if I look at investing, and this is really fascinating because this comes up all the time. You kind of need to understand what has happened historically with the stock market to understand how much time horizon can impact what you're thinking about doing. So if you look at, say, the worst 1 year that's happened, let's say since 1970s, early 70s, in the total stock market itself, it was down about 43%. So if you come to me and say, hey, I want to buy a house in a year, and what stock should I buy? Or, what portfolio should I have? The answer is you shouldn't have any at all. You should put that into your bank account, CDs, something that's guaranteed. Now, the best rate of return for a 1 year period, the market was up 66%. So you could get lucky. You could put money in, roll the dice, and hope that gain comes through, right? And the market does go up more than it goes down, so I think you have a slightly higher chance of getting lucky than unlucky. But my answer there would be that you shouldn't invest for that short of a time horizon. The worst 10-year rate of return was down 2.5%. And there hasn't been a 12-year period, at least since the early 70s, where you didn't have a positive rate of return. So longer-term outlooks for stock market mixtures is much, much easier to accomplish what you're trying to do, which is grow your assets, than shorter-term concepts. And I've run into a lot of people have a lot of misconceptions about that. And I've seen an awful lot of people with short-term goals rolling the dice. Obviously it didn't work this year. It worked in 2020. Worked in 2021, actually. Is not working in 2022. So really take a look at the time horizon that you have for your investments and consider what you're trying to do there. Either stick with the investments and change your time horizon. Like, hey, this money I was saving for my house, and it's in the market, it's down now, right? maybe I'll just use that for retirement or something long term.
Yeah.
I'll keep adding a little bit to it, and I'll build up the house money somewhere else. Usually it's hard to do that because houses are so expensive, right? It takes so much capital to do that. Or you just, get out of it and
Yeah.
maybe you change the time horizon when you're going to buy a house, right?
Yeah.
Wait till the market comes back around. Continue. I mean, if you're one, still a gamble, but I guess it's sort of a middle line, right? You can continue to buy, right? I'm going to buy, and okay, maybe I don't buy a house at the end of this year. Maybe it's 2 years from now. Okay, fine. I'm going to keep on buying because I'm already in. I've already lost money. I'm going to keep going. So, different strategies. But if you're starting off and you were to ask me about time horizon, that's what you'll find all financial planners and advisors. That's one of the first questions we have is, well, how long?
Yep.
How long do you
long?
have before you need the money? Because it denotes what you should do with that money. Because essentially you're playing a game of probabilities. And so I would be really careful for short timelines, getting involved with the stock market personally.
Yeah, and so that's why it's important if you're, looking out for retirement or in retirement, you want to have something that has, some sort of equity or stock portion because you need your money to keep growing. And so if you have 15, 20 years, it's likely that you're going to have a positive return. And so that's why you want to be in the market.
Yeah, that's exactly right. All right, everybody. So thank you for joining us again on another live show. I don't think we messed up too badly today, actually,
No.
so maybe it wasn't as funny. But nonetheless, hopefully it was informative. You've got something out of it. I encourage you to subscribe to the channel. Education, hopefully you saw today some of just a few pieces of what you might not know, right? So what else do you not know? And maybe you can pick up some of that by looking at these 800 videos that we have on the channel. And you can subscribe, hit the bell button, and of course, if you really want to, you can talk to Ethan and I, maybe specifically about things that you're concerned with for your own situation. And you can hit the book appointment button, on the top corner of our website, and we'd be happy to spend 30 minutes with you talking on the phone or on video. So, thank you very much for coming today, and I want to I really appreciate you coming, and we'll see you again next Friday.